Assalamu alaikum wa rahmatullahi wa barakatuh. Good afternoon, everyone. Bismillahir Rahmanir Rahim. Alhamdulillah, alhamdulillahi Rabbil Alameen. Wassalatu wassalamu ala Sayyidil Mursaleen, Sayyidina Muhammad. Wa ala alihi wa ashabihi ajma'een ma ba'd. Allahumma aftah alayna bi hikmatik wa anshur alayna bi rahmatika ya dhal jalali wal ikram. It's always an honor to present at the INCEIF conference. When we look at the growth of the conference and the level of discussions that have been taking place over the years, we've seen it being exponential. Yeah, in the beginning it was a bit slow, but listening to the discussions from yesterday and today, alhamdulillah, you understand that the caliber of the panelists and the discussions they bring already speak to the topic. They've already been deepening Africa's Islamic finance market, not just the capital market. So today, perhaps if we could go to the first slide, our journey is going to cover the core challenge, which is firstly understanding Africa's qualitative finance mismatch. And then looking at the conceptual solution, rather than from a technocratic perspective, I want to look at it from a pragmatic perspective, the pathways to implementation. And here we must separate African countries and how they've developed in Islamic finance. Nigeria is not the same as its neighbors. It's not the same as East or Southern Africa. And we'll look at that in more detail. We also have to look at a cautionary tale. What happens when we try and do not succeed? What are the reasons for failure? How can we mitigate and remediate? Targeted solutions to help climate action in particular for Africa, which is a huge problem. And then finally, a roadmap that we'd suggest for countries that have established Islamic finance and those that are entering the market. And I know sitting here, you have countries like Ghana sitting here that are about to enter the field, and then Nigeria, on the other hand, that has been in the Islamic finance sector for almost 15 years now. So looking at that contrasting African market scenario. So let's go on quickly to the next slide, please. So what do we mean by this qualitative mismatch? Well, we say it's a $170 billion question. We've heard a lot from yesterday to today about Africa's annual infrastructure funding gap. How to fund that? Looking for alternative solutions, alternative financing. Well, Islamic finance fits quite neatly into providing us with that solution, but there is a timing issue and there is a quality issue. So it's not that we don't have adequate liquidity, and you'd know that as Nigerian banks, especially non-interest banks, there is a lot of liquidity, but we don't have adequate vehicles to capture that liquidity and to provide competitive dividends. So what happens is we end up competing with conventional in terms of returns, and we may look for loopholes or legal devices simply to provide competitive returns. Now, Africa has bank-centric systems. Now, what this means is that capital adequacy is quite strong in Africa. Yes, you'd be surprised. During the global financial crisis, 2007, 2008, how many African banks collapsed during that period? There was one that was shaky, but generally, African banks did not collapse during financial crisis because of their huge capital adequacy. But this also means that there is inefficient deployment of capital. So we need to look at that in more detail. We have medium-term financing. FG and Sukuk is a good example. We have some long-term financing, but generally the quality mismatch lies in the money market and the long-term or perpetual investments. So that's where our gaps lie, and we'll talk about that briefly as we go along. If we don't address the mismatch, well, then we're not going to have a productive infrastructure sector, and more importantly, an SME sector that has not been able to access financing through standard retail banking initiatives. Let's go to the next slide, please. So, You hear this all the time. Africa has so much of potential. Africa is going to be the new green ground for the future of all financing, of all markets, of all economies. Potential is not performance. Africa has potential. But how do we actually pragmatically turn that into a roadmap that we are following diligently and we can correct as we go along to address the challenges? Well, we've got to ask that question. If Islamic finance is approximately $4 trillion US, which you've heard already, what's Africa's share of that $4 trillion? Well, it's not more than 2%. It's not more than 2%. If you were to use just a population assessment, which was between 50 and 60% Muslims on the African continent, then we have a serious mismatch here. 2%, is that what we can do? Well, there's a lot of work still left. Now, why is there that disconnect? It's not a simple issue of more policy, more regulation. It is not an issue of more awareness alone. Now, let's look at some of the countries and how they've addressed it. Let's go to the next slide, please. Firstly, Nigeria. So Nigeria has taken a specific pathway, and that was to build, through regulation, an Islamic finance sector which today has several non-interest banks and licenses waiting in the queue, asset managers that are so interested in opening halal funds or launching even fixed income halal funds, which a few years ago was something that you couldn't even match with Islamic. Fixed income and Islamic, I mean, that just seems like riba. But we know that there are structures in place to achieve that. Now, how did Nigeria achieve this success? And yes, it is a success story in Nigeria. It's because there has been a political will. There has been a champion. There has been an approach from policy, from regulation, from local dynamics, the increased awareness. There has been an understanding that Sharia audit and review is part of the process. Governance is crucial to the success of the sector. So this is how it has been built. Now let's go on to the other countries. Next slide, please. Senegal. Now Senegal has been slow in developing Islamic finance, but they have been very successful on the sukuk front. On the sukuk side, they have actually achieved an issuance without launching any specific Islamic finance regulation, which means that they've managed to fit it within their existing civil law. Now, you'd see that these challenges exist throughout the world. In Malaysia, you launch a regulation first, then you launch a sukuk. In South Africa, you launch the sukuk and you don't have any regulation. In the UK, there's no Islamic finance regulation, but they launch a £250 million sukuk from the UK Treasury. So if we thought that this is just a religious initiative now, I think this dispels any notion of it being solely a religious initiative. The United Kingdom has launched sukuk several years ago, 2014. So has South Africa, you've heard it. And South Africa is also about to launch their next sukuk, which will be 4 times larger, by the way. So, what has Senegal done? They've managed to adapt the civil law to allow for securitization structures, for a special purpose vehicle, for a trust-based vehicle to exist. And the approach has been legal pragmatism rather than a heavy technical regulatory approach. Let's go on to the next slide, please. Morocco and Egypt were not so lucky. In Morocco, they adopted what they referred to as a gold standard governance-led approach, which means that they want to go top-down, a Malaysian approach, top-down. And going top-down meant you need to have a centralized ulama council, scholarly council, and you want to ensure that you have best practice. But don't call it Islamic. That was the first requirement. Yes, participative financing, which is fine. We have no issue in you calling it whatever you like, as long as you are clear on what the foundational rules are, and if it is Islamic law, then you need to include that in your policies and regulations. You need to state what you're following so you have a standardized approach. But this was not successful in Morocco. Even today, Islamic banking and finance is growing slowly. It is growing, but it's growing slowly in Morocco. Now, what can we learn? A robust governance framework is essential for credibility, but it's not adequate. It's not sufficient for market growth. You cannot say we must have a strong governance framework and then everything will work thereafter. We have a case that shows us this may not be the pragmatic solution. Egypt is another example, and Egypt is very interesting because I'm sure any one of you sitting here knowing Islamic finance history will know about Mid Ghamir. The Mid Ghamir Bank starts Murabaha and presents it at the Islamic Fiqh Academy. They present it at the OIC, and the Islamic Development Bank is launched thereafter. So Egypt, in effect, is the founding thinker of formal Islamic banking. Egypt. So Egypt should be leading the world today in 2025, but it is not. It is not. In fact, Islamic banking has only actually resurfaced over the last 5 years in Egypt. Prior to that, it has been relegated to a very niche sector of the finance market. Now, what can we learn from Egypt? Well, they have done well. They have issued a sukuk, a sovereign sukuk of $1.5 billion, which happened to be oversubscribed to $9 billion in orders. It shows you that the market is thirsty for these types of instruments, but unfortunately, there aren't adequate options available. Now, why is that? Well, it's because the use of proceeds tends to be very government-linked. And Egypt, being a very strong military nation, uses much of their funding in building military infrastructure. So if you are going to use proceeds for that, you would expect that, well, your investors may not be that excited, but they were. They were. And if you know the IOFI Sharia Standard number 21, it says no investments in defense arms and ammunition, but here you have the use of proceeds in the military complex, and investors are still ready to invest, which means there is thirst in the country and they have not been able to supply according to demand. The lesson here, scale is not the same as impact. The sector has largely conformed to what is existing. They haven't actually transformed it. It means that if you want to see the success and deepening of an African Islamic finance market, you must be able to create positive impact. You must be able to create inclusion. And if you can't do that, well then all you're doing is providing a solution for a very niche market. Let's go to the next slide, please. Kenya. Kenya, unfortunately, attempted to launch a sukuk some time back, but because of a number of reasons, in 2016, Kenya was going through issues like climate change disaster, famine. 4.2 million people were affected by this famine. So a sukuk launched in that type of environment was hugely challenging, which means that in order to launch a sukuk or deepen your market in Islamic finance, it's not adequate to talk about regulation alone, which Kenya was not especially ready for. It also means that your tax laws, your securities laws need to be adequate. You need to have institutional capacity. You need to look at your environment. If you're suffering economic catastrophe or disaster, it may not be the opportune time. You need to have a political champion. You need to have a political driver from the top. So the critical lesson here is that even if Kenya has been going through the process of Islamic finance development for so many years, the success of it actually is a culmination of a variety of factors, not a single push. Let's go to the next slide, please. So, real opportunities in deepening the market. Firstly, Islamic finance is not just finance. It's about development. It's about empowerment. It's about ensuring that your client is not becoming over-indebted, but he walks away graduating from below the poverty line to above the poverty line, where he creates jobs, and this is a true trickle-down approach. But it also means now that we have to fund the SME sector adequately. And if you say, well, you know, the SME sector is hugely risky, they don't have collateral, they don't have a credit history, how do we support them? They don't even have a business plan and they want financing when they walk into the bank. How do we help them? Well, today, AI plus risk sharing can work exceptionally well as an algorithm. I know because we've developed it for one of the largest banks in Malaysia. They had the same issue. We created a digital platform for them where SMEs can log on to that. They can understand what their business is in terms of a litmus test. Is their financial policy or financial strength strong or not? Is their human capital policy or inventory policy effective? All of the things that a bank will ask you in terms of your own strategy and business plan, this system will ask you for it and will guide you on how to score a higher point. So at the end of a 20 or 30-minute session, it gives you a score based on your peer group. If you are in pharmaceuticals or if you are in manufacturing, it will tell you where you are. It will tell you what you need to do to improve yourself. And there is a bank back officer looking at what's happened. And as you improve, the system will now guide you to the right advices, to the right fintech solutions, to basically empower you to be a retail banking client. Before that, you need to develop. And you're being monitored through the process. So that's an important aspect. The other issue is mudaraba and the moral hazard. We face this everywhere. With AI, we can reduce the risk on mudaraba and musharaka financing. The other issue is tokenizing solutions. So the process of documentation for issuance of a sukuk can be simplified through a tokenized sukuk. There is a white paper on tokenized sukuk in Malaysia. Securities Commission of Malaysia is now aggressive in tokenizing sukuk. And the Central Bank of Malaysia has also issued digital assets and the approach for looking at how digital assets will be the focus of securities going forward. But we cannot separate the value of the token from the underlying project. This is the key Sharia issue that arises, that disconnect. And now you are buying and selling tokens or crypto. You are forgetting the underlying project, and that is not the objective here. Let's go on to the next. So real opportunities, parametric takaful, another opportunity, and I'll talk about that using Drive. Now, you may not have heard of Drive, but we're involved in a project called Drive in East Africa. And how it works is there's a fund of $360 million to support pastoralists, farmers primarily with livestock that are affected by climate change and other issues and conflict. They get takaful to cover their livestock. And if the bill for a month is $100 for contribution, the fund provides 90% and they contribute 10%. If there is a disaster in 3 years, they can claim. If there is no disaster, they can still claim a portion to recapitalize their own investment or their own business. Here's an interesting story. The World Bank and the governments in East Africa did not attempt to go down the takaful route. It was conventional insurance. But the farmers said, if there's riba, we don't want it. The insurance company said, but you will lose everything. They said, we rather lose everything than be involved in anything haram, because then we have lost everything. Truly. Then they reached out to us and we converted that into a takaful initiative, which is a huge fund, a $360 million fund. And that supports farmers. So something like that can be considered here. Let's go on to the next slide, please. Techno-regulation. I think everyone sitting here is using an AI model for something. And maybe not one model. I'm sure you are using multiple, some of you are using multiple models. If we are going to develop regulation, we need to create ethical barriers, guardrails for AI and how we deepen financial markets, because that is going to be a key driver for financial inclusion. We are developing projects and products right now that are primarily based on AI algorithms. But if AI is not kept in check, well, the disaster can be exponential. If you want, you can go and read the market crash that didn't happen in May 2015 on the New York Stock Exchange, when a bot made a microsecond decision to exponentially increase a trade that almost caused the collapse of the financial markets. Fortunately, it was corrected in time. But if it was not, in a matter of 5 minutes, you could have seen a collapse of a financial market. That is what we are holding in our hands. And if we don't protect it carefully in terms of consumer protection, data privacy, we are heading down a very slippery slope. So proactive techno-regulation. We are talking about deepening the market using Governance Challenge 2.0, and this means that we must have new and complex regulatory challenges. This is essential. We have that AI regulation in several countries in Islamic finance right now. I'm not seeing it in Nigeria yet, not seeing it in Africa at all, and that is a huge gap. Let's go on to the next slide, please. So, very quickly, a pragmatic roadmap. This is for new African markets. I'm suggesting 3 phases, key phases. First of all, you need to start up fresh. You need to look at your legal and institutional foundation. You need to look at market catalysis, or what are the key catalysts for your market. This means that you could potentially launch a domestic sovereign sukuk without the need for any detailed regulation, and allow that to reduce the friction in introducing non-interest finance. That spurs the market forward because you have a proven and tested model. This is how many countries have done it. Then you've got to have a roadmap for 3 to 5 years, build that ecosystem, but you cannot do it in silos. A bank needs a takaful company. A bank needs a capital market sector. And the capital market sector needs fintech and regulation to drive it forward. So you need to have a clear roadmap. Let's go on. Existing African markets like Nigeria cannot adopt what I've just mentioned. They need to look at a different strategy. A secondary market development, which we do not have here. We have a buy and hold strategy for sukuk because there are so few issuances. And then we have another issue where there are several private or corporate sukuk issuances, and because there's such a demand, there is a lax or complacency on the credit risk side of private issuances. So you may see defaults on the private side, and that just causes a reputational risk for Islamic finance in the entire market. So you need to look at it more carefully in how you are developing it. Secondary market will allow the trading of the sukuk as well. Incentivizing these sukuk would be usually beneficial, like Malaysia has done. And then sukuk is not the only game in town. There are so many other instruments that one can develop, from Islamic commercial papers, Islamic repos, a number of products, especially the short-term Islamic money market. There is a massive gap in Nigeria. Then you've got to strengthen the full ecosystem. You cannot focus on one aspect like the capital market alone. There needs to be a very clear roadmap of how every part of the ecosystem is developing. And this needs a national strategy even for human capital and capacity building. Let's go on to the next slide, and I'm ending now. You need a political champion. We know that, the Oga at the top, as they say, you have to have the power from the top driving, and you have to have the demand from the bottom driving. If you don't have these two synergies, you're not going to be running a successful market. You cannot simply have policy. Malaysia tried it. For 10 years, they had limited development in Islamic finance. They had only one bank for 10 years. Only when they opened that up did they start seeing success. So we have to consider a broader perspective here, and you need champions. And there needs to be succession planning, because like what happened in Kenya, you had a champion. The champion moved because he was so successful, the entire sector collapsed because there was no one to carry the flag. Let's go on to the last slide, please. So finally, a coordinated call to action for African markets. Governments, you need to have political will. understand that this is not much a religious issue as much as it is an issue of providing choice, deepening the market through financial inclusion, and bringing a market in that are actually quite liquid, and we are losing all of that liquidity, but it needs reforms. Central banks and regulators, well, you have to build an essential infrastructure, having basic regulation, building towards a dual banking system, and establishing credible governance. On the private sector, you have an opportunity. You've got to innovate new products, customized for your market. You cannot copy and paste a Malaysian or a Bahraini or a Dubai product. Things work differently in your country, even in your city. And you have to look at cultural reform or cultural norms when you're innovating your products. Finally, you cannot do it without the theorists, the academics, and the civil society. So you have to have courses and programs that are building capacity, and without that, you're not going to have those to carry that torch forward. I'm going to stop there. I've tried to keep within the time, and thank you very much for your attention. I'll move back to the moderator. Barakallahu feek.
Thank you very much. Thank you very much, Professor. This was very insightful. I hope everybody has taken a lot from it. I've noted 4 areas for our panel to discuss, to deepen the conversation today. Regulation and investor protection, emerging opportunities and lessons we can draw from advanced market, capacity building, capacity gaps, and lastly, market expansion and inclusion. So I will start with Mrs. Korede, if you don't mind, but it's a discussion. Anyone can bring his own perspective. So on market expansion and inclusion and what the professor has talked about at length, the SME. As we know, there is an issue around SME. In Nigeria, for example, less than 5% of funding from SMEs is coming from non-interest finance. What can we do? Which kind of practical, beyond infrastructure, which kind of practical steps we can take to include other stakeholders, the SMEs, the retail, the underserved communities. It was something that the Emir yesterday touched on. What are your views? What can we do?
Okay, thank you. Can you hear me, please? Can you hear me? Good afternoon, everyone. Thanks, Professor Ziyaad. I think that was very insightful. And Mounir, also, thank you for that question. First, one thing I picked away from Professor Ziyaad, he says potential is not performance. And that's the story of the SME business for so many years gone back. So in looking forward, I'd like to make a few recommendations along what we do both in our bank, what we see, and what we also expect to do. So, like we said, the potentials of SMEs are limitless. And for private institutions like banks, you cannot, because this is retail banking, you can't deal with them one-on-one. You have to get a lot of support. One of the greatest supports we believe that is sustainable over time for SMEs is using the agency model. So you have institutions or individuals who act like banks and represent the banks in what the bank wants to do. So some of those products for the SMEs, they can do it for you. They can also help to make sure that whatever the bank wants to effect will be done. So the other thing is that we have to look at SMEs in a way that how can we continue to do risk sharing? How can we use guarantees to support them? And how can we use maybe leasing, cooperatives, bringing them together so that you will be able to absorb the risk a lot better. The other thing we look at, even though that has not come into fruition, is how can we use Sukuk to support SMEs? I mean, you would traditionally see Sukuk being used for corporate and commercial names. One of the things I picked up was that you could use, for example, we want to support SMEs in agriculture. We can say 70% of the funding will be for the big boys and the rest will be for the SMEs. You manage your risk better and you manage your returns better. I also think one of the things that we need to continuously do, a lot of people are doing it, a lot of institutions are doing it, don't underestimate the effect of financial literacy. Most of the SMEs, when you speak to them, some of them don't even need money. They don't need any funding. All you need to do is explain to them how things work, how a business works, how at the end of the day, know what you have in hand. The cash in hand does not mean only the cash you have available for the business. It represents other things. And for us, I mean, that is one constant thing we do for any SME we onboard. I also think we should continuously look for DFIs so you can blend financing. It's not only the banks that can do this. The development financial institutions can work with the banks to make sure that overall, at the end of the day, the SMEs can afford the kind of funding initiatives we want to do. And also with tech now, you can actually, Professor Ziyaad mentioned that, you can use AI to monitor these SMEs better. So at the end of the day, the cost to manage an SME is very much more reduced than what we had seen before. I think I'll stop there. Thank you.
Thank you very much, very insightful. Professor, let me come back to you. I mean, the success of non-interest finance is obvious, 735% oversubscription for the last sukuk. You mentioned something during your presentation. We don't want the OGA from the top to dictate things. Nevertheless, let me ask you, in order to push Islamic finance into mainstream capital market, which kind of regulatory or policy shift change we should adopt?
So very briefly, the issue of regulation and policy should be that it's not rigid, but it is enabling. If it is not enabling, then your market is going to be strangled and not grow. Also bear in mind that any policy interventions will drive the market in a particular direction. An example is Malaysia talks about risk sharing at the highest level. But in terms of policy, the regulator is also risk averse and therefore tends to drive the market unintentionally into more debt-based products. So there's this dilemma here. You want to go risk sharing, but you can't do it because your hands are tied. And this is something that we need to take care of when we're talking about policy intervention. Sharia governance is another issue that needs to be standardized, but there is a gap. So having a strong set of fit and proper requirements is great, but then the market needs to respond to that by building a pool of Sharia scholars. And perhaps, regulators and policy drivers, are cognizant of the fact that we don't have adequate, scholars that are skilled in Islamic finance yet. The overall disclosure and investor protection should be enhanced. This is a crucial gap. And especially when it comes to issues like private issuances, these tend to fall through the gaps. There's leakages. And here that drives, poor reputation of the Islamic finance sector. So how can policy or regulators ensure that they are reaching out to those private issuances whilst not implementing too much of a rigid stranglehold on it that it doesn't grow? So we need innovative products, but policy needs to have a lighter touch on those elements. I'll stop there.
Thank you very much. Very insightful. We will go on the next session. Next part, lessons from advanced market. I will ask you, Mr. Osama. We mentioned various countries, Malaysia, Bahrain, the UAE, and so on. Which kind of key lessons or best practices can Africa adopt from this advanced market? So that we can expand our reach on infrastructure, social project, and so on.
Thank you very much, Mr. Mounir, and thank you, Prof, for this wonderful presentation. Bismillahirrahmanirrahim, and good afternoon, everyone. So regarding the lessons to derive from the GCC in terms of what they have done so far in improving the Islamic capital market and generally their economy. If you look at it, basically most of the GCC countries, they look at the foundation is basically on 4 foundational pillars. And each of these pillars, when you look at it, we can draw a lesson from what they have done. The first one, if you look at the strong government support, they have a strong government support. For example, if I give an example of the Saudi Arabia, which also is a major hub, the foundational pillar for the NEOM project is also Islamic Finance in terms of they are going to source the funding for those projects from the Islamic Finance instrument, which basically is Cook and other instrument. And also when you look at the Bahrainian economy, if you look at Bahrain, you see presently, as at the last quarter of 2025, the Islamic finance industry is valued in excess of $80 billion, and it seems to also move to more than $100 billion in the next 3 to 4 years. So on all these GCC countries, there is a strong government support, which made them to achieve what they really. There is a deliberate action by the government to ensure that they succeed in all what they are aiming to achieve. Then secondly, and from this, we can also, from when you look at the African perspective, we can align our national development plans, to embed the Islamic finance in terms of sourcing for funding for the gap in terms of infrastructure and other things that we need to do. Then secondly, you will see they have a very strong legal and regulatory framework, in all the GCC countries, which is also very critical that we need to have. For Africa, I know few countries, especially Nigeria, a lot has been done around that. And I think other African countries are also looking at what Nigeria have done so far to see whether they can also replicate similar, which is also very important. So the part of the lessons, I think Nigeria has also, which is part of Africa, they have also seen that lesson as key. And all the regulators from the Central Bank to the Insurance Commission to the Securities and Exchange Commission to the insurance, they are all looking at coming up with a robust regulatory framework to be able to achieve the desired result. Then thirdly, also, if you still look at it because of the investors' confidence, there's the aspect of Sharia governance framework. They have a very robust Sharia governance framework. And some have decentralized Sharia governance, some have centralized Sharia, decentralized and centralized Sharia governance framework. Even though when you look at it, there are some other jurisdictions that are having two, maybe dual banking system. They have laws for the Islamic finance and Islamic banking related to Islamic finance, and also for the conventional places like the Malaysia, places like Bahrain as well. But others don't have those specific laws. It's just that one is embedded within the other. So these are also lessons that we can learn, which will help, especially in the context of Nigeria, when we have laws that's specifically for the Islamic finance and also the conventional. That will help a lot because there's a lot of a kind of non-alignment in some kind. Then the last one that they have they are working, which we have to also learn from, is the issue of capacity building. For instance, if you look at it, Bahrain, they have done so much. If you look at most of the Bahrainian, most of the standard setting, but like the AWOFI is built in Bahrain, and a lot they is deliberate. And then secondly, also if you look at Saudi Arabia, I think they are also looking at the number of scholars compared to the Islamic financial institutions. I know in 2018 from the statistics I've seen they have 0.5 and they are trying to move it to 1.6 by 2025. At the same time also the government is deliberate to ensure that they have a lot of scholars from Saudi in multinational institutions, Islamic financial institutions globally, and also other multinationals, which they want to also move it from about 16% to 23%. So these are deliberate things that we need to do, because coming into just a little digression here, you will see that in Nigeria currently now, we really lack the experienced scholars that will be able to match the upcoming non-interest financial institutions. So this is something that is very key. Thank you.
Thank you very much. Very insightful. You have touched on so many aspects. Mr. Aminu, I would like to have your perspective on market expansion once again. What can stakeholders do to leverage on the strong demand for non-interest finance to scale at a larger space to achieve a better market diversification?
Thank you. Thank you very much, and an excellent conference. It's a great pleasure being here. I think for large-scale infrastructure projects, in my estimation, I think three things need to happen. Number one, for market depth, we need to find a way of mobilizing and motivating long-term local currency capital towards infrastructure financing. And the easiest way to do that is through guarantees, well-capitalized, well-governed, and well-managed guarantee propositions. Without that, conservative capital like pension funds that would always prioritize safety and liquidity and then returns will actually never be attracted to such an area in the financial market ecosystem. So I think the first thing is guarantees. The second thing is that we have to, as quickly as possible, move away from government being the principal issuer of sukuks and transition to an ecosystem where the private actors themselves have the knowledge, have the capacity, and have the appetite to actually issue sukuk themselves. And what needs to happen for this to be the case? I think we need to have not only the project preparatory facility side, but also the advisory side in order to prepare projects adequately to be bankable, for them to be the right set of issuers in order to be able to facilitate capital flow into the purchase of those instruments. So I think that's number two, the project preparatory side. And I think number three, the regulatory side is extremely important, just as we had today with the DG of SEC actually coming here and showing that not only is it a priority for the regulator, but personally also offering his own support into ensuring that that this ecosystem of Islamic finance is a priority for him is also important. So I think a combination of those three things: number one, guarantees; number two, project preparatory; and number three, the in-kind support of the regulator is fundamental. Thank you.
Thank you very much. Very insightful. I'm being pressed by time, so Professor, I'm going to skip you for the last question. And I will make my question very short so that the panel can really contribute. I'll come to you again, Mrs. Korede. Last night you won an award for innovation. Congratulations. On that, we haven't touched on digital and technology. What can fintech and digital platforms play into the expansion of the non-interest finance?
Okay, thank you very much. And thank you for mentioning that we won the award for innovation. Okay, one of the major lingos we use in the bank is the fintech partner is your friend. We're not in competition, because we know that there are quite a number of things we can do together that would make things better, either for the bank in terms of profit or even for your retail customers. For example, we've been talking about sukuk here, sukuk for SMEs. the best way we can do that is work with a fintech. They have more reach. You use the technological capabilities they have to reach more people. And more people being those retail people that can actually, that you have a lot of funding with them and get it into the financial system. So we work a lot with fintechs because we know that it's going to be advantageous to us. I mean, even if you're talking about tokenization, it's working with fintechs. Even if you're talking with, we have a product that deals with gold. The only reason why a retail customer can buy gold is because we've used technology so that, you know, you can have other investment outlets. So, I mean, there is no limit to what technology can do. And especially now that we're also talking about AI, AI is also one of those things that would help us to work better in all our financial intermediary endeavors. Thank you.
Thank you very much. Very insightful. Mr. Korede, no, so sorry, Mr. Osama, sorry. Sukuk, I mean, Sukuk have been mainly deployed into infrastructure, not focusing on other areas like healthcare, education, renewable energy, and so on. What should we do to make those sectors attractive also?
Okay, thank you. So what I see, all the Sukuk issuance in Nigeria presently is basically directed towards roads construction and probably recently maybe metro, and then so I think there is another area which we need to look at, which is the renewable energy. It's a very promising area, which I know a lot of deal and a lot of the investor appetite around that. So it's one area that I think we need to, and we have abundance of the sunlight, for solar systems generation, which I believe Nigeria also is doing a lot in terms of trying to bridge that gap. Then another thing I always think of, probably maybe, is it only Sukuk? Don't we have other capital market instruments that we can use also to finance infrastructure, especially with regard to the health sector? Which I have been thinking maybe can't we use IRET, Islamic Real Estate Investment, to see how we can model it to fit into providing healthcare infrastructure in terms of the buildings, in terms of the equipment and everything, maybe to be more or less like PPP, whereby maybe the SPV will be there to get the money from investors, and then maybe construct the hospitals, provide the equipment and everything, and manage it, while the government will not be paying over a certain period of time, which is a model that has been practiced especially in UK and other places. So I'm looking at maybe then other areas also which we can also try to use it. It has to be when you look at agriculture, the healthcare that I've made mention. But when you plot a school for healthcare, you just have to construct. What I'm trying to see whereby the government will not be in charge of managing the hospital and every other things like that. Maybe an SPB will do that. So these are other areas that I think the Sukuk and also any other innovative capital market instrument can also work and can bridge the deficit that we have. Thank you.
Thank you very much. Mr. Aminu, so Professor Ziyaad mentioned the issue about liquidity and secondary market activity. We are mainly in a buy and hold mindset. What should we do? What should stakeholders, regulators do to improve that issue around liquidity and secondary market activity? What are your views on that?
Thank you. My solution will be, first of all, market education. Secondly, market makers. And then thirdly, breadth of products. You need a combination of those three in order to begin to get the kind of liquidity within the system that's much needed. Thank you.
Thank you very much. Lastly, because really I'm receiving signal about time, and then we'll take 2 questions from the room. Professor Ziyaad, I will finish with you because you are, of course, the professor and the academic. We have been talking a lot about capacity gaps. So there are not enough scholars, there are not enough professionals in finance who are conversant with non-interest finance. What should we do? I mean, to improve this, to get people to do advisories and so on. What are your advices?
Number one, build a pipeline of talent. And here the NFIs, all of the, the institutions playing in the non-interest finance sector must now be able to invest in their own future. That means that they cannot simply be playing musical chairs, where someone is moving from one NFI to another, because this is what is happening right now in the market. You have to build a pipeline, and that means you have to support universities and educational centers with Islamic finance chairs, with doctoral scholarships and postdocs, and those postdoctoral fellows need to sit at the central banks, at the securities commissions to learn what's going on, to sit at the high level of different banks, and then they can contribute. If they don't do that, they're not going to be able to guide you. Have CPD program, a continuous professional development program for all Islamic finance staff that includes Sharia supervisors. In this way, it's mandated and you know that they are growing. Ensure that you match junior scholars with senior scholars. This is not happening in the market. Right now, you have just a handful of scholars sitting on the board or the committee on the ACE, a project that we implemented some time back where we had about 5 scholars to 6 scholars for every committee, but 1 or 2 of those were always junior. And they were expected to learn, and then there's a rotation. They will only sit in that position for 2 years or 3 years, and then you bring in the next young scholar. So that rotation has to happen. Advisory market development, the Sharia advisory firms and audit practices, there should be a continental registry of all the advisors available and what they have done, so that there is a cross, technical skill, sharing with these advisory firms. I'm going to stop there. There are many others that I have, but I stop just by saying set KPIs so that at the highest level, you know that it's measurable and you are actually moving the market. I will suggest you look at ASAS in Malaysia for Sharia scholar development. We've been very successful with that project, and it's a 2 to 3 year project of getting scholars ready for the pool of talent, which we know there is a big deficit in. Thank you very much.
I like that set KPIs. This room is full of executives. So I will advise everybody to take it seriously. Let's be intentional on that. Let's set KPIs to achieve. We need to do that journey. To go through that journey together. So now we will take 2 questions from the room. We are really pressed by time. Okay, I see 2 here on that table. Okay, so please, you heard the MC, go straight to the point. We are really pressed by time.
Thank you very much. My name is Kamal Okwola, the first Vice President of the Institute of Capital Market Registrar. My question is, how do we ensure that Islamic finance truly deliver inclusive growth and doesn't simply replicate the inequalities seen in the conventional finance? That's in line with what Madam mentioned of supporting SME, that probably 70% for the big boys and 30% for the SME. Are we going to be ensured that it really achieves what it's meant to achieve, inclusive growth? Thank you.
Thank you, sir.
Thank you very much for that question. I think for me, the way I see this is when we as a team or a group or a set of people have decided that this is the way to go, we must be intentional about it. For example, when I said 70%, 30%, we must be intentional about it, because otherwise, we are not going to grow. So that's the first basis. We decide these are the KPIs, let me borrow that term, of what we want to do for the SMEs. When we decide what they are, for example, that any sukuk that comes out for any sectoral sukuk, we must have 20 to 30% for this set of institutions. If we say that, we must put our efforts towards ensuring that is met. And usually I always say, really, non-interest finance, like the professor said, is about impact, which is very unlike the conventional type of banking. So when you do something with this set of people, even they at the end of the day will be able to say, this is what I came out of. I think he gave an analogy of above the poverty level, and you will move those set of institutions from below the poverty line to above the poverty line. So what I think it's a simple answer. It's just about intentionality. When we're ready that this is the way we want to go, and we all face it with support from governmental institutions in some cases, I think we'll get it done. Thank you.
Thank you very much, Mrs. Korede. You have a question? Same table? Only one.
Thank you very much. This question goes to Professor Ziyaad. During your speech, you mentioned that during the financial crisis of 2007-2008, Nigerian banks were not affected because they were adequately capitalized. That is, they had adequate capital for the level of risk they carried. Now, how does this translate to inefficient capital management? Thank you.
Yeah, I didn't say they weren't affected. I said that we didn't have any major collapses. And how does this translate to inefficient capital management? Because banks in the Scandinavian countries, are on the borderline of 8% when it comes to capital adequacy. Countries like Ethiopia were on 18%, Nigeria around there. The point is that if you are not managing your capital efficiently, then the risk-based capital charge will be much higher. And the central bank is not going to allow you to overextend yourself. So efficiency means that you can go closer to the risk line. But we can't do that if we aren't efficient. And that is the argument from scholars.
Thank you very much. This brings us to the end of this session. Apologies for every other person who had questions. MC, thank you very much.